two elements on the economic front that we need to deal with today. CPI quickening to 3.6%. Yeah. That is for November from 3.4% in October. And obviously the Reserve Bank bringing that data forward, given the holiday.
No, I think it makes sense that it did come forward. And it still really reflects a fairly subdued picture. Obviously, that it's a bit higher than the low that we've seen just 2 months ago. I think is indicative that the rand itself during October was slightly weak relative to the previous months. I think that had some influence because the inflation rate really has become a function of the currency, and I think with the strength that we're seeing now will probably filter through by the January, February, and probably serve to keep inflation reasonably low for this.
So that September print 3.2%, do you believe was the low point in inflation in South Africa?
If the rand has reached the low point, but I think as I believe that the rand will get stronger, that the inflation rate will hug these levels, around about the 3.5% sort of area. Maybe even
chance
going below
of dipping below the band, the bottom end of the band?
If the rand is exceptionally strong, in other words, getting to say 6.50 to 6, that sort of area, the possibility of going to that, going below 3% is still there.
The relaxation of exchange controls even further. Now pension funds, asset managers and the like can take 5% more in offshore.
Yes.
Your thoughts on this front? Were you expecting it?
Well, we knew that there was an announcement whether it would come yesterday or not was another story, but the relaxation, I think, is a reflection that the authorities have got a reasonable amount of confidence that at least there's some backing, that it's not just inflows, that it can actually be matched by what we'd call portfolio outflows as well. And I think that's positive. The big question is, from an asset management point of view, is up to 20%, you could say it's a strategic decision, you want more or less there. But for a South African client, what is the optimal to actually have offshore? Our models at Investment Solutions, the modelling that we do suggests somewhere around about 30%, funnily enough, would be an optimal amount in terms of the diversification. But already above 20%, you can see the decision starts to become more tactical rather than strategic. Certainly, while the rand is strengthening, while the flows are coming in quite strongly, is this a time to actually take money offshore? Not sure, but our markets are starting to look a little bit more.
If you take the money offshore, where are you going to put it? In what currency in particular?
Well, that's the point. Is the currency is a problem, and the markets are a problem. But we when you look at the actual entire universe of tens of thousands of stocks offshore versus the few
very
hundred
limited universe of stocks in South Africa.
Exactly. There's a lot of value that you can find in offshore markets, and one needs to reflect that there's the emerging markets as well, that you've got, it's not just South Africa that you can select. So it's a difficult decision at this point, but certainly the additional flexibility, I think, is to be welcomed. The big question is, the rest of exchange control, what purpose
are they still holding for the country?
Already we reached the point 10 years ago where exchange controls were providing no benefit at all. And I'm talking about a practical sense. You can always describe a theoretical benefit, but there is no practical real benefit that South Africa derives from exchange controls in their current form. And I believe we've reached the point long ago where we should have actually ditched it completely. In other words, normalized the situation. This is such a legacy set of regulations that are
now redundant, effectively.
They're completely redundant. I mean, we're part of the family of nations. We don't. These were introduced when Sharpeville happened, when you've got an artificial situation and a rogue government effectively in place. We don't have that as a problem, and I think these regulations are well past their sell-by date.
What are your thoughts just now coming to the interest rate decision in January? Now that we've got CPI at 3.6%, is there any chance we're going to see another cut, or is that completely out of the window?
No, I still believe, let's watch the rand. It's trying to dip below the 680 level again. When we compare the rand to where we were at the last MPC meeting, it's strengthened quite a bit.
On a trade-weighted basis now, because we're stronger against pound and euro.
and also we're getting to the stronger levels of the dollar, back into the 670s, etc. If we're a bit stronger, let's say we're at the 650 level, the 9 level or 890 or so to the euro, for instance, the Reserve Bank has to respond to the quantitative easing happening externally.
But what impact does it have on the level of rand? We've seen repeated cuts, and we haven't seen the rand weakening to any extent.
I don't believe it will, but at least it helps to counterbalance that we're not paying away. But we cannot just cut interest rates. We have to take measures to make sure that we don't end up in a consumption binge, that it actually gets funneled to investment. And that's where we need to look at the tax policy, and I think that needs to be radically overhauled. We cannot be taxing the savings and investment arm. We need to be shifting the tax burden onto the
there needs to be
consumption.
Incentives for savings and investment in this country.
Exactly, or certainly no disincentives, and put the tax burden onto the consumption side of the economy so that we can get this investment led. Otherwise, we're just going to end up in a consumption binge. With the interest rates at these levels, they're already too low for savings. You can't tax that as well and still expect a decent outcome. So we need to actually pay attention to that.
We've got the Fed meeting this evening, and of course there potentially is more quantitative easing on the cards. They're not going to do anything on interest rates sitting at 0.25%.
No, exactly.
Potentially those are staying at 0.25% for the next 3 years without any hike.
What I'd be very keen to hear is that the last time they met, they said quantitative easing here's on the table. The purpose of the quantitative easing is to keep yields low. It was 2.4% then, it's now 3.3% now. In other words, since then, the yields have run up quite a lot.
So it hasn't been effective to the tune that they wanted.
Well, the point is that their quantitative easing has generated more selling than what their quantitative easing would have actually created in demand. So we're now looking at a policy dilemma. Do they escalate it to get yields down, or do they let things be and let yields escalate and really hammer the housing market and make a double dip an absolute certainty? Let's see.
Do you believe that a double dip is almost an absolute certainty right now?
Well, I believe that these measures are actually part of the problem. They're actually not part of the solution. They're what I call balance sheet depleting methods, printing money, spending money that you haven't earned, etc., and raising debt levels. I don't think they're actually helpful, and I think the solution that emerging markets were faced 10, 15 years ago of raising rates and cutting back government expenditure certainly seem to be the right but very bitter medicine.
Well, ahead of the Fed, the dollar is coming under pressure, and we're just seeing the seesaw from the Eurozone to the US.
The weak, pathetic euro is being out-weakened and out-patheticated by the dollar at the moment.
Exactly.
What else do you do? And this is where the problem comes. It ricochets back onto the rand. What do we do about it? We have to focus on other things like productivity, etc. It has to be part of our policy.
Just want to get your thoughts on the Eurozone and the weak, pathetic euro, as you point out. The fact that we may have to see this financial stability fund, the 750 million euros, 750 billion euros, excuse me, increase. Do you think that they are going to acquiesce?
They need to double it so that they can accommodate Spain. I mean, what else can we say? And then when they start coming to Italy, do they then come to the end of this experiment? That's the key thing.
Are bond yields still ticking up in Germany?
That's still, but it's lagging US because the German bond yield is still within the Eurozone, the safe haven
place. The
safest
of the Eurozone.
So it's performed slightly better, but yields generally have risen because they realize we're actually in an end game. You cannot keep going along with this experiment, keep printing money and still hoping for a neutral outcome.